Hello everyone, welcome to our Elliott Wave analysis. So today we're gonna see a very popular technical analysis tool, and I think it's quite famous. I think you, if not used it before, definitely heard it before, Elliott Wave analysis, and it's part one. So today we'll have an introduction. So a second webinar will follow at, what's the date? It will be early November, if I'm not wrong. So part two, it will be a more advanced one. So this will be mainly for intermediate or beginner traders. So before we start, so let's move on. As usual, for any issue, just stick it in the box. I will try to check if it's from my side. If not, please check your device settings or log in, log out from our application, webinars application, or my webinar as a webinar website. Sometimes that works. So try login and log out. Also, if I don't manage to cover any kind of questions, because we have we have a limitation in the length of the webinar, please email to us to webinars@hotforex.com, and we'll try to reply as soon as possible. So it's me, Stuart or Nectarios, that will reply in your email for any kind of questions you have, either for the webinar or in general. Hi, Bruce. So Bruce, welcome to Elliott Waves analysis. So let's go through disclaimer. These materials provided as a general marketing communication for informational purposes only. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. We make no representation, assume no liability as to the accuracy or completeness of any information provided. We shall not be held liable for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading forex and CFDs may not be suitable for all investors and carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment capital. So admin is out of our way, finally. So it's me. Hello everyone. I assume all of you have attended to our webinars before. So if not, I'm Andria. I'm a market analyst here in Hot Forex since 2016. So nearly 2 years now. So we are here for helping you guys. Anything you need, just email to us or through Facebook from Stuart's Facebook page. Is Stuart's Hot Forex Cowl. So we'll try to help you as much as we can. Okay. So that's all from me, but because it's a lengthy webinar, that's why it was split into 2 parts. I will start as soon as possible. So today we're gonna see together what actually the Elliott wave is. Oh, I'm sorry for that typo. I wrote way instead of wave. So what the Elliott wave is and the background, I mean, who invented it, etc. Some basic rules regarding Elliott wave theory, how you could read Elliott wave. So that leads us to how you could actually identify some signals using Elliott waves and breakouts and reversals. And also we're gonna have a look at some examples. Unfortunately, I didn't manage to find a lot of good examples, but I have a few. So but no worries. If anyway, we will have a part 2 webinar. So anything that needs a longer explanation or anything that it needs to be repeated, it will be done in the part 2. So, guys, before I start, is any one of you identify ever before an Elliott wave and try to trade with it, or I don't know, is there anyone that never heard it before? Okay, of course, there are people that never used it before because it's quite rare, or it needs a very, very I mean, you need to be very careful when you check your charts in order to identify an Elliott wave. But is anyone ever identify or is trading with Elliott wave analysis? Anyone? It's a quick yes or no, just to figure out how I could continue with the webinar. No. Okay. 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 No, never used. Okay. So just don't worry about it. It's not something that you can easily identify, but once you do, it's good to like put it like in a highlight in your watch list, because if it's satisfied, if it's confirmed, it's a very, very powerful technical tool. So let's start like with a short background. And of course, it was named after its creator. So Ralph Nelson Elliott was actually the creator of Elliott Wave principle. What is Elliott Wave principle? So Elliott Wave is a form of technical analysis which is used to help us analyze the market trends, locate extremes in investor psychology, and to forecast future market trends. I will explain these two highlights in the next slide. So before I do that, what I mean by the extremes in investor psychology, how the market trend can be analyzed using Elliott Wave, I will just make a brief introduction. So as I already said, it was created by Ralph Nelson Elliott. So Elliott was actually an accountant. It was not an economist. It was not didn't have any like a mathematician, because we have seen that many tools have been created by the mathematicians. So it was scientists in general, or economists. So it was an accountant, actually, in one of the biggest railroad companies. However, he was a trader, and he spent 20 years of his life actually studying stock markets. So back in 1930, Elliott, who actually believed that the markets are not random or chaotic, they are actually predictable. So he discovered that the stock market trend and reversing a recognizable patterns. So he believed on that, and he believes that the market repeats itself. Sorry. So Nelson actually was the one that found that the financial market have movement characteristics that can be repeated over and over again. So he called these repeatable patterns, these repeatable moves, let's say waves. Okay, so so that's why he created the Elliott Wave principle. Yes, Esther, is recorded. If you cannot stay with us in this session, after the webinar, our support team will forward you, we will provide you the link for the webinar, okay? So, as I was saying, Elliott actually created it was the developer of Elliott Wave principle. So he described actually to us how these patterns are linked together, these repeatable patterns are linked together to form a larger version of themselves, and how they turn linked to form the same pattern at the next larger size, producing a structured progression. So this is what called the phenomenon, the wave principle. So actually, I said at the beginning, that's a very popular and powerful analysis, the Elliott Wave analysis, the Elliott Wave principle, because it's a principle that was actually proven almost almost 100 years now. So it managed to prove 100 years proven results. So it is confirmed that it works. So if you identify something like that in any kind of time frame, you have a very, very high a very, very high probability of actually confirming its result. So it's something powerful. of course. So as I was saying before, let me move to the second. So I was saying before, it's a technical analysis tool which is used for traders, investors, etc., in order to analyze market trends and to locate the extremes in investor psychology in order for us to be able to forecast the future market trends. So let me put this in a more simpler way. So wave principle, according to Elliott, okay, is a circle in which the market generates trades. So it moves in a trend, okay, all the time. The market is moving in a trend. So the market actually is traded in waves, either on the upside or in the downside. So these waves, as I was saying in the previous slide, sorry. So you see, I have next to the picture of Elliot, I have the basic Elliott wave circle. So as according to Elliot, the market is moving. The market is actually generally is a wave which is subsidiary of smaller waves. So what I mean by that? So according to Elliot, as I was saying, the market is traded in waves. So these waves, guys, okay, are a result of repeatable circles. So market is repeating itself. It repeats the same movements again and again. So what is very interesting about the Elliot logic is that he took into consideration that the market acted not just on the technical analysis, okay, not on the technical side only, but also it took into account the emotional perception of investors. That's why it's a very interesting tool. Because so far we have seen many technical indicators, patterns, and etc. So we have seen a lot of. If you go through to our webinar sessions, you see that we have a lot of technical analysis in. But the interesting thing about Elliott Wave is that it identifies the emotional perception of investors. Okay, so basically, Elliot watched the outside market influence. He understood how the psychology of the majority of investors reacted. So therefore, we have always, whereas so far we have always based our analysis on how market reacts on the technical side, he gave us a more important indicator, which is the emotional reactive of the market. So I will make this simple as simple as possible. So I was saying market trends. Markets are moving up, down, sideways. You agree with me? Are you okay so far? So market are moving up, down, sideways, but you always have a direction. Even if it's going sideways, you see that it's going sideways. Or if it goes up, you know that it's going up. There is direction always. So that what actually results in a trend. If it continuously going upwards and upwards, we have an uptrend. So these directional moves are called trends. Okay. However, every single trend, either in an hourly chart or in a daily chart or in a monthly chart, they have a beginning, but they have an end, right? If you're in an uptrend, at some point it will end and you will turn up downside. So at every end, there is a new beginning. The markets are never stopping. They are going up, down, sideways. They never stop. Okay, so firstly, it helps us to sorry, excuse me. It helps us to identify the trend. Okay, so this is why he is claiming that markets are not random. They go up, they go down, so they have a direction. Either either sideways, either up, either down. So, but the second very, very, very important key is that he has managed to create something that is located on the extremes in inverse psychology. So, as I was saying, like in simple terms, what I mean extremes in inverse psychology. When a trend begins, okay, only few of us are aware of it. I mean, we cannot easily identify a trend from its start, from its beginning, very beginning. So when a trend begins, okay, we have. Let me put the next maybe. Okay, when we have when a trend begins, only few investors or traders really know about it. But as the trend develops, it becomes easily recognizable. Sure, are you okay with me? So if you see trend like the market going up and up and up, and you realize it, you want to enter. So as the trend develops, more and more people are joining it, right? Because there is a confirmation that, oh, we have a trend over here, so let me enter. I want to enter. So at the end of the trend, at the end of each trend, almost everyone, every investor, every trader, every etc., every market participant in general, have already they are already in. Okay, they are already in the market. So what that causes, if the majority of the investors are already in, so, and they are sharing the same opinion, they're sharing the same opinion. So if we're in an uptrend, almost the majority of the investors are saying, oh yes, we are going upwards. We have the same opinion. We are in agreement. We are going upwards. But if the majority of the investors share the same opinion about the market, and the opinion is that the trend has just begun and will last forever, okay, ironically, when everyone already joined the trend, there is no one left to support it, right? If everyone is on the bull side, let's say, there is no one to support, to actually support the vice versa, the bearish side. So there is no one to support this uptrend. So there is, in simple terms, there is no power in it anymore because everyone is in already. So no one is like pushing for that trend to continue. So here is when we have a reversal. Okay. So usually at the time of the reversal, just to let you know, over 90% of the people are the ones that believe in this trend. So that is what we are saying extreme in investor psychology. At the beginning, only few participants knew about the trend. As it develops, more and more and more traders are entering and they are joining this trend. But at the end, everyone is already in, everyone is trading already on the side of the trend. So there is no one to actually support it. There is no one to actually imagine if the 90% is already in the market, there is no one to support this trend in order to continue its direction. So that's why we have a result. We have the end of this trend and hence the reversal of the trend. That's why this is where Elliot he based his principle. Market trends and the investor psychologist. So this helped him to forecast future market trends. He was a stock trader, so he used it a lot for stocks. However, you can use it in any kind of market, currency market, stock market, bond market, anything. It can be applied anywhere, and it can be applied. The good thing that just few indicators manage to do that is that it can be applied in every single time frame. So that's the theoretical part. Hopefully you're with me so far, but we are done with the theoretical part. Let's go to see to actually see what that Elliott wave principle is. So as I was saying, Elliot describes the upward and downward swings, the swings upwards, upwards, or downwards, 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 as a waves. Okay, so as we already said, it represents the mass psychology. But the far more interesting thing, and why I put actually this nice broccoli over here. Okay, I will move. Okay, so it's the fact that another interesting thing actually, despite that it is based on the psychology of the people of the participants, is that it's not only that it's based on emotions, but it's a collective pattern as well. So what I mean by that is that every action has a reaction. So if it goes up, it will react and go down. If it goes down, it will react and go up. So it's also a collective pattern. Every action has a reaction. Physics. So Elliot was able to analyze market in greater depth, identifying actually the characteristics of these wave patterns and making detailed market predictions based on this pattern that he was seeing in the market. Imagine this as a chart, okay? Imagine this as a, let's say, a euro dollar chart. Let's say, okay, so he was able to make some prediction based on the existing on the existing pattern. So as I was saying, another important quality of Elliott Wave is that they have a fractal nature. For people that they were before with me in the fractal webinar, they already know that fractals are everywhere, either in nature, but especially in markets. Okay, so what is a fractal for people that they have not attended our fractal webinar? So fractal is just a mathematical structure, but what that mathematical structure is saying that every small scale infinitely repeat themselves. Okay, some examples of fractals in the nature, just to let you know, is broccoli. It's broccoli. Why? So what I mean by a fractal? So as I said, there are actually small scale infinity there are structures that repeat themselves infinitely. So Elliot actually discovered that stock trading patterns were structured in the same way, so they have a fractal nature. He then began to look at how these repeated patterns could be used as a predicting indicator for future market moves. So what I mean by that, that they have a fractal nature. You see, if you notice over here, I will put it in a highlight in a pen. So this is, why I cannot write? Sorry about that. So and how I erase that. Okay, it has a bit of delay. So this is a wave. Are you agree with me? Everyone with me? Do you agree that what I draw is one wave, two waves, three waves, four waves, etc.? Are you with me? Are you agree? Yes. So Donna and Ahmad, what actually this is? Or what this is? Isn't it again a wave? Wave, wave, right? So what fractal means, guys, is that one structure has smaller structures with the same pattern beneath it. So it repeats themselves. So if you zoom in, the smaller scale is the same kind of structure of the larger pattern. So fractal is when we have this kind of like the large scale is one wave, but we see if we cut it, if we zoom in, you see that, okay, oh, it has a smaller structures, the same and the same, smaller and smaller and smaller ones. So Elliott Wave has also fractal nature. In general, markets have a fractal nature. So I will not spend. I know what. Again, thank you, Ahmad. That's why you reply so fast. So you're using fractals. That's why you are aware of them. So okay, good interpretation of fractals is broccoli. As you notice, it has a P, is the shape of a triangle, but you notice that there are small triangles, small ones beneath it. So, um, so what I'm saying, so as I was saying, in the financial markets, we have the financial markets have a fractal nature, so they repeat themselves, and that's why we have for every action the market itself creates an equal and opposite reaction. So this is a good interpretation. Let me erase that. Sorry. As a good interpretation of fractals. And of course, Elliott wave theory. We have waves. Those waves have other waves, substitutory waves on it, subdivisions of their move. Or if you zoom in further, the same thing, the same pattern. So in markets, we know that every action creates an equal and opposite reaction. So as a price movement is up or down, then definitely, at some point it will follow by a contrary movement. So you go up, then you probably have a correction lower. If you go down, then you probably have a correction to the upside. So price action is divided into trends and corrections or sideways movements, okay? So trends show the main direction of the price, okay? This overall picture says that it's going up. However, we have some small corrections on it. So these corrections is what it was labeled by Elliot as corrective waves. So the upside movements are called impulsive waves, and the downwards, no, sorry, actually the waves that are going along with the trend, they are called impulsive, and the ones that are going against the trend, they are so corrective waves. Sorry. So simply put that, I will simply put that. Movement in the direction of the trend is unfolding in 5 ways according to Elliot. Okay, this is the Elliot wave principle. So according to Elliot, the movements in the direction of the trend is unfolding in 5 waves. Okay, these are called motive waves, while any correction against the trend is in 3 waves. Okay, that's the overall picture. So this move up is called motive wave, and this moves down, the A, B, C, are called corrective waves. The movement in the direction of the trend is labeled, as you can see, with 1, 2, 3, 4, 5. The 3 correction waves is labeled with A, B, and C. These patterns can be seen in long term and the short term as well. It can be applied anywhere. So ideally, smaller patterns can be identified within bigger patterns. So if we zoom in, if I cut just this wave, this 1, 2, and I've zoomed into a smaller time frame, I can see, oh, again, I have 5 corrective waves, 5 motive waves, 1, 2, 3, 4, 5, and then 3 corrective ones, 1, 2, 3. If I zoom in again, I will see the same pattern repeats itself. 5 up, 3 down, 5 up, 3 down, 5 up, 3 down. So smaller patterns can be identified within bigger patterns, fractal nature. In this sense, Elliott waves are like a piece of broccoli, as I'm saying here. Okay. So And okay, I will mention it now. No, I will confuse you if you. Okay, I will. Okay, I wanted to say about the relationship with Fibonacci, but it's like I will. I'm afraid if I confuse everyone. So, okay, um, let's move on. Any questions? Don't hesitate to let me know. If you have any question, just take it in the box. In the box. Yep. Okay. So far, so good, I assume. Yep. Cool. So now I told you before, and I don't know if hopefully I didn't confuse you. We have 5 motive waves, impulsive waves, and 3 corrective waves. Okay. However, within the 5 impulsive waves, we can say that number 2 and number 4 also can be called corrective waves. Okay, why? Because we are up, we're going upwards, but we have an impulsive wave which is moving the same direction of the trend, but at some point we have seen a correction lower. We have seen a reverse line lower before it continue its direction to the upside. So 2 and 4 can also be called in the smaller picture can also be called corrective waves. So the same stands for the downside for a downtrend. So impulse waves is 1, 3, and 5 because they are going along with the trend, the overall trend. Okay, but 2 and 4 are small corrections to the upside, so they are called corrective waves. Okay, so in a bullish, so the principle, as you may understand, the Elliott wave principle is 5-3 wave pattern. This is his name. 5-3 wave patterns. 5-3. So what is summarized is that during any trend in the price move, any trend there's in the market, in an asset, in gold, whatever, any trend. In any trend, the price moves in the direction of the trend in 5 waves, okay? Despite the correction, we continue going up. So the price is moving in the direction of the trend in 5 waves and then retraced in 3 waves. And then the circle repeats itself until it completes a reversal, like a confirmed reversal. So what we mean by that is that, okay, it did these corrective waves, these 3 corrective waves, but if it continue, so if we have a short correction like that, and then a sharp decline further, so that is like, is another circle, but a downward circle, okay? So the set of these 5 waves is an overall impulse wave or motive wave. You can find it in both names. And the set of the next 3 waves is an overall corrective wave. So in a bullish market, how you can identify an Elliott wave principle in a bullish market? So in a bullish market, the impulse move comprises 5 moves that in sum take the market higher, right? Overall, you can see that the price goes higher and higher and higher. So we have these 5 moves. So which if we take a closer look, there are 3 impulsive ones to the upside and 2 corrective ones to the downside within an overall uptrend. So on the other side, in a bearish market, the impulsive move is made up of 5 moves again, 3 impulsive that are going down, so they're taking the price lower and lower and lower, and 2 corrective ones, okay, 2 and 4, which are taking the price slightly up. Okay, we said that 1, 3, 5 are impulse waves, 2, 4 corrective waves. Before we see some rules about Elliott waves, I will explain what each wave means. So Okay, I will take as an example the bullish market, but the same thing applies to the downwards movement as well. So what does wave 1 means? Wave 1 means that the market in this time frame, in this session, the market is making its first impulse wave, establishing an uptrend. Okay, actually, yeah, an uptrend. So this is usually caused by just few people, few traders who are testing the market, just testing the market. So that's why we said the beginning of each trend. Remember, not all the traders or the majority of the traders are aware that the trend has started. Just few of them. So here we are in the beginning of the trend. So the wave 1 is just is caused this move up higher. It has caused by just a few traders that are actually tracing the market. So as we can see, the market was maybe the market before it was in a downtrend or something. But anyway, that doesn't really matter. Currently, we have seen a move upwards due to some traders that are testing the market. In wave 2, we see bears, okay, trying to retreat some ground. So the market pushes. So the market is like pulls back with wave 2, but it is not strong enough to keep the market flowing back, flowing actually in a downtrend. So this is not a strong move. So bears have trying to gain some ground, but not successfully. Okay, they are trying to keep the market into the downside, but they can't. So that's not enough. This is what we've seen in wave 2. In wave 3, which usually, please highlight this thing because you will need it. Usually and typically, wave 3 is the strongest of the waves, and this proves that the trend is now definitely set on an uptrend. Okay, this is typically the strongest wave, the strongest from 1, strongest from 5. So that actually proves that the trend confirms that, okay, we're in an uptrend. Definitely we are in an uptrend. So it gives you the confirmation that definitely we're in an uptrend. The same satisfy also in the downtrend. So this should be the biggest, the strongest wave, and this could confirm that we are indeed in a downwards movement. Okay. So let's go back to the example of an uptrend. So the public, the wave 3, in general is trading. In general, I mean the investors that are actually trading, saw that rally, and everyone in the third wave, everyone is trying to ride the wave to enter the market. Okay. So that's why it's a strong one, because everyone have identified, oh, we have a confirmation of the trend of an uptrend, so let's enter. Okay, everyone wants to trade. Nevertheless, then swing wave, which is wave 4, considered to be the time when the bears, sorry, the bulls, okay, they have entered, but the bulls, the people that actually were in a buying position, are cashing out, are cashing in on their profits. That's why usually the wave 4 is based on the cash out action. So the price has already become quite like expensive, and therefore they want to cash up. It's time to cash up. Hence, the retracement and the pullback is what we call the wave 4. So we have a corrective wave to the downside, because the price went quite high and everyone wanted to cash up. So this selling over here caused this small movement downwards. The final wave is wave 5. So this is by far one of the most difficult waves. Okay, is one in which many traders get caught up and make mistakes. So why is that? Because everyone everyone try to enter without be patient. So this is typically driven by too much emotional trading. So people, they're saying, oh yeah, it will continue going upwards, it will go upwards forever. They don't usually put any stop loss, any kind of, they don't manage their risk. They are quite they really they are like, they really is the time that where you will observe that there is a too much of emotional trading. People try to catch up with the uptrend. They make extreme mistakes without setting any take profit or stop loss, because they believe that the upwards movement will last forever. No, that's not the case. The market is not driven by hysteria. Okay, so this is where we can see the most of the mistakes. Okay, so yeah, so actually people that have not identified before the uptrend, they try to catch up with the trend at the 5th wave. So so that was the case with the uptrend. The same stands with the downtrend. Okay, so the idea, guys, of these impulsive and corrective ways is used to determine when a trend is changing directions. Okay, so this is how impulsive and corrective ways are helping us. If a price chart shows big moves to the upside, the small corrective ways in between are suggesting to us that a much larger move will occur. Okay, in the overall picture, that stands for the corrective waves over here as well. So we had a very we had an upside movement, big moves to the upside, big ones, 1 and 3 and 5. They're quite big ones. So okay, you can benefit from these small corrections, but you also have to take care, because at some point this cannot last for longer, and at some point you're gonna have also a much larger down movement. Okay, that's causing A. Correction C. So it's a signal. You have to take care of this 1 to 5 waves, because at some point you have a signal that the uptrend may have over. So you might consider selling and entering a down movement. So impulse occurs when we have a trend direction. So the big move to the downside, which is bigger than prior corrective waves, and as large as the upwards impulse wave is, it indicates that a trend is now down, is reaching to an end. If the trend is down, okay, like this case over here, the bearish market down, if the trend is down and we have a very big wave, up wave, which is C. C stands for the same, has the same role as E3. So the C should be a big one. If you see a big up wave, that is as big as the prior down wave. Okay. Then we end up that the downtrend is reached to an end, and we might see, we might have to look for buying opportunities if we have seen this sharp, a very big, strong candle to the upside. Okay. So many opportunities, either entering on here or selling in the near term once you see the correction, or wait for these corrections to confirm and enter the market in the 3rd wave. or wait for this to be completed, these 5 waves to be completed, in order to trade on the corrective waves, to trade on the downwards movement. Okay, so there are many opportunities, either in the long term or in the short term. Okay, so it's a good tool because you see the example later on. It could actually provide you also, excuse me, target levels and stop losses. So just briefly, I will briefly say just an example. Okay, I didn't catch up with the trend at wave 1. Okay, but I noticed that it made a small correction and then tried to continue to the upside. So a good entrance in the third wave will be once it break the previous high, this peak of the wave. So a good entry level will be that. Okay, so stop loss immediately. You have a stop loss below your previous low. Okay, otherwise, if you see that, let's say it reached that level, but it tried to consolidate and is moving to the downside, then immediately stop loss can be placed above your peak. Okay, above your peak, and the take profit, it will be set according to Fibonacci levels. We'll see Fibonacci with waves with Elliott waves in our example. Okay, I will move on quickly to say to mention you the rules, because before we see this very nice example. So rules. Let me check whether you have any questions so far. Where's my question box? No? Question box? Where did I put my question box? Oh, you have questions. Sorry. Try it on a live chat. Yes. Sorry to hit. I will quickly cover these 2 slides and we'll go straight to example. How to figure out the market's bearish or bullish in the first place. So simply, if you see higher highs, you see it did a corrective move, but his next move, it managed to cover a higher high and the higher low price. That is what forms an uptrend. If you see lower highs, lower lows, that means that you're in a downtrend. And I repeat myself, this can be identified in every single time frame. Okay, not only daily one. It could be identified let me find an example just quickly. Okay, dollar cat. I have also fractals on, that fractals helping, but if you see down fractal, down fractal, down fractal, down fractal, but this is getting higher and higher. So my lower, I have higher low prices, higher low prices. If I join them with a trend, you see that they point upwards. If I join my fractals, okay, sorry. Okay, you see that they are going up and up and up. And if I join, I also have higher highs, higher highs, higher highs, higher highs. So I was in an uptrend before retracing lower. So if you're seeing higher lows and higher highs, you are in an uptrend. If you're seeing lower lows, lower highs and lower lows, you're in a downtrend. Okay, so that's not fully satisfied, but you don't need to satisfy both. If you see lower lows, you're still in a downtrend. Okay. Simple as that. So let's move on. Some basic rules regarding Elliott waves. So something that you have to have in mind is this slide and the second one. So rule number 1, believe it or not, there are only 3 rules that comes when interpreting Elliott wave. So rule number 1, wave 2 cannot retrace more than 100% of wave 1. So what do we mean by that? Wave 2, okay guys, here, cannot move below the beginning of wave 1, below the low price of wave 1. It will never reach. If it reached, then you are not in an Elliott wave principle. Okay, never reaches, never managed to go as low as wave 1. So even though, so the rule number 2, wave 3 can never be the shortest of the 3 impulsive waves, can never be shortest from 5th and from 1st wave. Okay, typically, I repeat that before, is the longest of the 3 impulsive waves, longer than the longest than the first and the fifth one, longer than the first and the fifth one. So there is a specific rule that it cannot be the shorter one. Okay, never be, because as we said, here is where the majority of the investors trying to catch up with the trend and they're entering the market. So this is typically the longest one. So I already said that is yeah, can never be the shortest one. So the if you're like question yourself, how can I measure if the big one? Just measure it. Measure the wavelength. Put your let me go back to the so if you have the cross and you drag and drop, you have the length 1453. That stands for 145 pips. So you can measure it easily, okay, by the cross indicator. So Elliott wave indicates that wave 3, okay, I'm still in the rule 2. Wave 3 must exceed the high of wave 1. So you see, Elliott wave principle can only be confirmed if the third wave is the longest one, but also if it exceeds the peak of wave 1. Failure to exceed this high means that it will probably retrace downwards again. It means that it's not in an uptrend. It cannot confirm an uptrend, okay, or a downtrend, depending on our case. So a failure to exceed this high would actually call for a recount. So impulsive moves are all about making progress, okay? Failure to exceed the high of this wave, of this peak, this wave 1, 2, it will call for a recount. The third rule and the final rule is simple. Again, wave 4, okay? You see wave 4. I think this is a very good indication. Wave 4. I was taken from the stock charts.com. It's a very good chart. So wave 4 cannot overlap wave 1, which means the low of wave 4 cannot exceed the high of wave 1. Okay, so wave 4 must be above the peak of wave 1. Okay, if it goes down below the peak of wave 1, no, that's wrong. That is when the bears have gained the control, so it will continue to the downside, and we are not in an uptrend anymore if it goes below the peak of the wave 1. So always wave 4 cannot overlap wave 1. Okay. So far so good, I think. Yes, I think it was quite clear. Is this a recording? Yes, yes, Lawrence. Yeah, no worries. No worries if you missed the beginning. I will send you a recording as soon as I'm done. If I open a new chart, how do I know which wave of Elliott Wave the price is in? This knowledge, I think, will help you. Okay. Give me a second to cover also this thing, and I'm with you, Thomas. Okay. Yeah. We have seen the basic rules. Let's see, however, some guidelines, because these guidelines, you have to put them down somewhere to have them, because these guidelines is what will help you actually trading Elliott Wave. To know when you enter and exit, when you have to go set your target, your stop loss, when to enter, to exit the market. So as I said at the beginning, there is a relationship between Fibonacci retracement and Elliott wave. So the theory refers to the market correction, which is expected to end at the area of support or resistance level, as denoted by Fibonacci levels. Okay, so the areas that actually refer to market corrections or the end of a trend can be identified or denoted by support levels. So Fibonacci levels can actually help you identify the wave before it actually formed, or identify when is the best time to enter the wave. So Fibonacci ratio is useful to measure the target of waves move within the Elliott wave structure. So different waves in Elliott wave structure relates to one another with this Fibonacci ratio. So we can use that. So, okay, I will briefly read them and I will go to apply them in my chart. So just typically read them. As we said, wave 2, okay, can never reach the low of wave 1. So typically, wave 2 could reach could actually reach 50%, 61, 76.4, or the maximum 85% of the wave 1. So it goes down by 85.4% of the upwards movement that it was seen in wave 1. No more than that. If it reach the 100, if it reach the wave 1 low, then then that's not a corrective wave. Okay, so it's likely to continue to the downside. There are a lot of bears in the market. So the maximum that has to reach is 85.4 of wave 1. Wave 3 can reach the extension of the Fibonacci up to 323.6 of the move of wave 1 to 2. So if you plot the Fibonacci retracement from this level up to this level, the extension I will give you in order for the wave 3 to be satisfied, that wave 3 is the stronger one. So the maximum that can reach is 323.6 or maybe more of the wave 1 and 2, but no less than the 1.61.8. I know that these are just numbers for you. I will show it to you right now on the chart. So before wave 4 is typically 14, 23, 34, but never more than 50% of wave 3. It can never, remember, it needs to be above the peak of wave 1, but never to reach the 50% of the wave 3. Wave 5 is typically 61, 100, and 123.6 of wave 1. So it typically be either at the same length of wave 1 or 61% of the length of wave 1, or the maximum 23% higher than the length of wave 1. Okay, I know this sounds like a lot of numbers for you. Let's put the charts on. It was about time, right? Okay. Oh, sorry. So let's put me back over here. I'm missing my Fibonacci to have them in the next slide so I could manage to help you. So as we said, so here, okay, it's a weekly basis, but I put that on because it was a very good example. Okay, so Euro Swiss in a weekly basis. So we have, you can see I was in a sideways movement, but suddenly I have this pick up. So that was my wave 1. It's not something that you could identify on spot, but okay, when you do, it's good to keep an eye on it. So wave 1, wave 2, wave 3, wave 4, wave 5. Okay, that's an impulsive overall wave for weekly basis for Euro Swiss. So as we said, okay, let me go back to my MT4. Okay, Euro Swiss, here we are. We were in a sideways movement, slightly down, but quite neutral for a long time during 2016 and etc. But we had this peak at the mid of 2017. So we have seen this wave one. And as I already told you, remember, we have to have these rules in mind. Okay, so you didn't, no one is, it's not easy to manage to find the wave one. It's too risky to enter in wave one. You don't know if it will last. So, well, it was okay. It was seen, it was going upwards, and then we noticed this downwards movement, which I wanted to measure. Remember, the wave two is typically the maximum up to 85.4% of wave one. So, and the minimum 50%. So I wanted to measure. I wanted to measure how low the wave two went. Okay, so I put a Fibonacci. Let me zoom in order to help you. Oh, sorry. So wave one. This is wave one. And I zoom in. I have a correction to the downside. This is a corrective wave. So according to the rules, wave two must be typically 50% and above of wave one, but never to go as low as wave one. If it goes down here, then it's not a corrective wave. Okay, it means that bears are gaining the control. So we want to measure it. I'm putting, sorry, I put it vice versa, to be honest. So I'm measuring this upwards movement, and I noticed that the wave two went down to as low as nearly 50%. Nearly 50% of this move, this upwards move. Okay. Okay, so it satisfies our rule. Our first rule is nearly 50% of the wave one. We are fine. We said that wave three is the highest one, is the longest one. So we had this very sharp rally, some corrections, but still on the upside movement. So wave three is nearly 323.6% higher than wave one. Okay, so if you plot your Fibonacci, you'll see that you have also the extensions. So the wave three, actually, before it started to retrace, it managed to go up to, okay, that's not exactly on 361, but it's a little lower. But even though it's way larger than wave one, it exceeded our limit, which was up to 161.8, and it reached up to nearly 350 something percent of wave one and two. So we have a very strong wave three. So again, another satisfaction that we are in an uptrend, and we probably gonna have an Elliott wave theory. So up to now it's satisfied. So on this move lower, the wave four, not to be satisfied, is usually less than 50%. It must be less than 50% of wave three. So I'm putting another, sorry, oops, come on. So I'm plotting, sorry about that. I'm plotting my Elliott wave only for wave three, just to see how far the corrective wave four went. So you can see, and again, I did the same. Okay, sorry. You plot your Fibonacci, and you see that thank God, Elliott, the wave four didn't manage to go as down as 50%. Be careful, it must not go below the 50% of wave three. So that's good. Okay. So we are indeed in an Elliott wave, and then we typically had the wave five, which is it needs to be either 61% of the length of wave 1 or up to 123.6% of wave 1. So how you could measure it, either with the cross, okay, you put your cross, you have 334 pips, yep. And if you go and measure the wave 5, you must have 61% and above, up to 123.6% of wave 1. Okay, this is not easily by the cross. What I'm doing actually is measuring it by, with Fibonacci. So I'm putting my Fibonacci in wave 1, and then I drag and drop it, okay, into my wave 5, and indeed, sorry about that. This is the support earlier. So indeed is it exceeded the 61% and higher of wave 1. So here I have my wave wave 5. If you think that the bottom is not here but is here when there was a lower price, then again it's satisfied because it reached above the 100% of the wave 1. So how you could benefit, actually, when you could enter or exit the market, etc. Of course, wave 1 is very, very difficult to identify. Even wave 2 is very difficult to be traded. But once you see that on the third wave, the price exceeded the peak of wave 1, okay? Clearly, in this situation, it exceeded. We had 2 weeks, positive weeks, and the third week it exceeded it, and he held above that, okay? So that is when you could trigger that, okay, I might see a wave 3 being confirmed, so I'm wait to be confirmed. And once you have this closing above the peak of wave 1 is when you enter in the market. So to be on the safe side is when, okay, sorry, is on the closing of this candle over here. This candle closed above the peak of wave 1. So you could enter here, stop loss to be placed below the low. Okay, below the low, so below the low price of corrective wave 2, and target could be set based on our percentages of Fibonacci extension. So I always said wave 3 will move above 161% of the wave 1 and 2. So you could set either your stop loss on 161 or 361, or it's quite risky to place it on the last level. So maybe at the mid of 261 and the mid of 361. So you have 1, 2, 3 target levels that you can use. Once you enter in long in the corrective way, in the impulsive wave 3. Okay. However, it's good to place your target closer, so 161. And if you indeed exceed it, like this big candle, and close strong, then you can enter again and gain some more and try to benefit on this very, very big bullish candle, which suggests a strong bullish market. So that was once you want to benefit, when to enter once the corrective, the impulsive wave 3 is confirmed. Also, you can also trade on the other side. So once the corrective wave reaches to this end and you see this bearish candle moving downwards, then you want, in order to confirm that you can enter again the market, is once you see that, and I will put that on, that wave 4, which is a corrective wave, didn't manage to go down to the peak of wave 1. Remember, we said that on this chart, wave 4 cannot overlap wave 1. So once this is confirmed as a support level and you see these two bullish candles, then you can again enter the market. Okay, because it retraces, it rebounds, it's still above the peak of the wave 1. So we anticipate a continuation of the uptrend movement. Yeah, that goes regarding and stop loss in this situation, again below this low over here. Okay, stop loss below, and target can be identified using Fibonacci. So remember, you could either, in the wave 5, typically the target can be set at 61%, 100%, or 123. Unfortunately, I didn't put the 123, but you can add it 123 by changing your Fibonacci properties. If you want to benefit also, if you want to also trade the correction opportunities over here, then you may notice that, okay, I have this uptrend, this trend line, okay, on the corrective way, sorry, in the corrective wave 3. So if I identify this negative movement, this bearish movement to the downside, and my the trend line, let me, oops, sorry, okay, corrective, okay, you can put actually connect your lower high, higher lows over here, and you have a trend line. So on the break of your trend line, of your upside trend line, you can enter the market short. Okay, on the break of it over here, stop loss can be placed above the latest peak, and Fibonacci, and then the target can be set. Okay, can be set. Let me put again that in. As we said, wave 4 is typically okay, so sorry about that. Is typically wave 4 is typically the up to, and I put it vice versa. Okay, it's typically up to from 14.6 down to 38.2 of wave 3, no more than 50%. So your target could be either set on the 23.6 or closest to 38.2. It's risky to put your target on 50% because it might never be more than 50% of the wave 3. Okay. And last but not least, before we end our session, is, so as always, is the corrective waves of the overall bullish market that is satisfied by Elliott Wave principle. So we had those five waves, right? So let me go back to our principle. We have those 5 waves, and is likely to have 3 corrective waves, A, B, and C. So that actually is something that happened in our market. So we have these 5 waves, and we saw a very sharp decline to the downside. So I will set a trend line at the low of wave 4. So I noticed that wave A was very sharp to the downside. However, it didn't manage to break it and rebounded to the upside. So that makes wave B. So according to Elliott Wave, the next movement will be sharply lower. So indeed that happened. We had 1, 2, 3, 4 bearish candles, bullish ones, but the fourth one closed below our trend line, our support level. So this support now is converted to resistance. So once it broke, you could enter the market at this closing, okay, with the stop loss to be set at the previous high. If it's too far away, set it to the last one, to the previous one over here, or you could just simply, okay, you can just simply put your Fibonacci again, okay, and set your target up to 138.2% or 150%, and etc. That's where your target should be on the on this selling position. Once you notice the break of the trend line, so this is the significant level. Let me change the color in order for you to, so that's a red one. This was my strong support. Hit it once, hit it twice and rebound, and now it was hit 3 times and break with this strong bearish candle. So at the closing you could enter a sell position with a target down to 138.2% Fibonacci extension, or maybe 150, depending on your risk and reward ratio and your trading strategy. So that was all from my side, guys. So a call for questions, for any questions like the. So I have to close the session. So can you please? We have I have a lot of questions actually. I replied to those already. Have replied to those. Recording, yes. So even though in the waveform may be higher low than wave 2, if it has overlap wave 1, then there is no Elliott correct. So Donna, I'm not sure if I understood your question. Wave 4 may be higher low. Wave 4 has a higher low than wave 2, yes. If it has overlapped wave 1, in order to, it has a higher low than the low of wave 2, but it never must, it must never overlap the peak price of wave 1. Okay, it needs to go as far as the peak of wave 1 and rebounds in order to satisfy an Elliott wave corrective wave. You see, in my chart, the 4 went down, but it didn't manage, it didn't overlap the peak of wave 1. Okay, so yeah, it goes down, but it must not go below the peak of wave 1. Can you please send me the PDF file? I will have recordings for sure, so don't worry about Hamed. So if we enter a peak of wave 1, so if we enter on peak of wave 1, so I'm not sure what you're asking, Tohid. You want to enter on the wave 1 to the downside, to the corrective wave. If you do that, just for gaining some few pips, okay, this is not a good example. Let me find out if I could find another one. Dollar yen. That's not a good example either. The best that I could find was Euro Swiss, but let me check. Let me check if I could manage to find another one. New Zealand is in a downtrend. Up, down. No. Okay, it's difficult to find right now another example, but not sure if I understood your question. Maybe. So if you enter on peak of wave 1, if you enter what, short? And when you want to enter short? I mean, you have to have some signs that it will return lower. Okay, you need to confirm. If you zoom into the daily chart, okay, we have wave 1. This is wave 1, and this is wave 2. If you want to enter in the to enter a selling position in corrective wave 2, then a good entry point should be on the break of this peak of this these two latest fractals. So over here, I'm afraid for just a few pips, target level. It's actually not too. It's actually so on the break. This will be your entry level. Yeah, because the fractals over here, the support that these four fractals were providing, it was broken and close below that. So you could benefit around how many pips? 22 pips. Not bad. Not bad at all. Okay. Can we? What's the question? Sorry. Can we use a zigzag line from MT4 to help identify the Elliott wave? Yes, of course, up to you. And also we'll cover zigzag and triangles and wedges on the next part of Elliott wave, the part 2, so don't worry about it. Where will be our stop loss? It should be, if you're in an uptrend, it should be below the previous low. If you're in a downtrend, it needs to be above your previous high. Yes, Andrea, you're welcome, Patricia. Yes, you have a recording, but it can still be an uptrend, just not an Elliott wave. What do you mean, Donna? Tell me exactly right now. I mean, on this example, what do you mean? It may be an uptrend, just not an Elliott wave. Remember, there is not only a buying opportunity over here, it's also a selling opportunity. You could either benefit from this correction lower and sell. You could either buy on this move upwards. It's not something that there are opportunities all over this place. There you're confirming that you are in a wave, in a wave, an Elliott wave. Okay. But remember, even if it doesn't satisfy 5 waves, every break of the previous support or resistance. Let me clear this chart a bit. Delete those. Okay. And I delete my waves. Never mind. I'll plot them again. Okay, so remember, even if you cannot confirm these 5 waves in Elliott, anyway, the break of this previous high over here, this break and this confirmed upwards bullish, very, very big candle confirms you and gives you the indication that we have a lot of bulls in the market and it will continue the upside, okay? And it's of course more than it has already recovered more than 100% of the first of the initial move higher. Nope. Will not manage to put Fibonacci correctly. Okay, you see, so okay, you don't have to wait for the 5 candles for the 5 waves to be confirmed. You can either enter from the third wave. So on the break of this high and on the confirmation that I have already gained up to 161% of the Fibonacci extension, you can enter long anyway. Please send me recording. Sorry if it goes lower than wave 2, then it is not an uptrend either. Yes, Donna. The corrective wave 2, it must not go below the 50% of the wave 1. Okay, because what that means, if it goes lower, then that means that bears are entering. We have a very, very strong bearish movement, a strong bearish momentum. So if it goes below the 50%, it's likely to go down to 61%. So even lower. And that's an example. Let me find. Okay, here is an example. If I put my Fibonacci over here, I saw that I had this downwards movement and went down to it reached 50% and it continued moving lower. It actually went below the previous low. So if the 50% is extremely important in every single in every single case that you are using Fibonacci. Okay, if anything that goes below 50% is likely to retest 61.8% as well. Okay, so another question, guys, before I end up with this session. Oh, this is another example. Oh, that was Euro Swiss again. Yes, sorry, it's the same that we are looking that we already checked. So until I have your final questions, here are the forthcoming webinars. Technical indicator basics with Otto tomorrow, and if I'm not wrong, he's gonna cover okay, he's gonna cover a variety actually from technical indicators. And how they can serve your strategy in a different types of indicators. Live analysis again with me on Tuesday, and Stuart will be back on 30th to give you a live analysis as well. Nectar is going to cover on next Wednesday the carry trade. So what the carry trade is, examples of successful carry trade, and how interest rates can help you manage this strategy. Also, scalping strategies to be explained. And last but not least, on 31st of October, Stuart gonna give a webinar about how to improve your trading mindset. So how to maintain your discipline, few simple numbers you should know, key levels, and how to the importance of emotional control. We have already seen the importance of emotional control today with Elliot, because it's based on the extremes in investors' psychology. So it's something that for sure affects the market and drives the market. So anything else, guys? Anything else? No? Once I'm closing, I will download and send it to support. So if not today, actually today should be today the case by 5:30 our time, my time, guys. Okay, so have a great trading session for the rest of the day, and see you next Tuesday again. Bye bye. Thank you for attending. Thank you again. Bye.